Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a certified financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And today on our show, we're going to be talking about something I spoke about in January around the debt ceiling. We think here at One Capital Management over the next few months, this is going to be widely discussed in the news. You're going to see some of this coming out. And I want to touch on a few principles today in not only how the government should be looking at what they're going to be looking at here regarding the debt ceiling, how we as individuals should be mirroring that within our own personal finances, and obviously how it relates to our retirement plans and our ultimate investing life. But before we do, remember to go to our website at onecapital.com. You can click on our media tab, and there you can download and subscribe to the Make Your Money Matter show. You can also download the podcast on Spotify, SoundCloud, the Apple iTunes app, Google Podcasts, whatever platform you would download a podcast. And I'm asking each of you, leave us a message. Give us a feedback. It's always good to hear from you. So with that, as I mentioned, let's talk about what's going to be coming up in the coming months. So again, we think it's going to be filled with probably some nasty rhetoric, some tension, probably some brinksmanship like we saw earlier in the year. So let's ease in here by going back to times when it didn't exist and actually was a mere formality, believe it or not. And debt, by and large, was viewed much differently. So back in the 20th century, get this, it wasn't uncommon for people to invite close friends and family over to their homes, serve food and drinks and all that good stuff like a barbecue, okay? And then have everybody gather around while they burned the mortgage. You heard me right, burned the mortgage. Kind of think of it like a second housewarming, if you will. I mean, the debt, of course, at this time for this party was satisfied. And the parties who were throwing this party were meant, and those who were there, were meant to celebrate the homeowner's release from what usually amounted to their biggest financial burden. Sounds not too dissimilar to today. I've been doing this for nearly 20 years, and a mortgage and actually the value of the house are typically the largest on both sides of the ledger for any household. It's the largest debt typically people carry. It's also the largest investment and value that our households typically carry. So now, while this was more prevalent in the early 1900s when larger down payments and short-term loans actually prevailed at that time, the ritual nonetheless kept momentum throughout the century, and actually, believe this, was a centerpiece of episodes of the iconic shows like MASH, think Colonel Parker's Home in Hannibal, Missouri, remember that? And the show All in the Family, remember Archie's in Queens? Many of you, I might be dating myself and others, but you know what I'm talking about if you get me here. Now, while mortgage burning parties haven't gone extinct, they're much rarer these days. Mike, you haven't probably heard of that before, right? And that's true for a couple reasons. First, with 30-year loans, refinancing, and obviously excessive leverage, like interest-only loans, for example, and the mobility nowadays, far fewer people ever really actually pay off a mortgage. And I'm going to talk about that today. And as a matter of decorum for a second, in some circles, the bashes are actually considered, kind of bragging about one's lot in life. So that's why you haven't seen a whole lot of these anymore. And you can look this up, and it's actually a very interesting dynamic of culture, which I always like to bring to the investing world here on our show, because I think it has a lot to do with how we relate to ourselves in society, in culture nowadays. Now, while the idea of a mortgage burning party might sound fun, maybe not, I don't know. Now, these recommended ideas, by the way, could include a backyard fire pit to like roast hot dogs, maybe s'mores, and then also throw in the mortgage. I mean, you can see the imagery there, right? And now, the idea of not sending out a huge chunk of cash each month by paying off this mortgage might actually sound even better. And here, in the first couple minutes of our show today, I'm going to share something that might be a little bit controversial. Let's decide together. You can leave us a comment on our social media. You can obviously leave a feedback here on the show. But paying off your mortgage might not always make the most financial sense. Now, I'm going against a lot of people out there that might be saying otherwise, but hear me out. It comes down to two main factors, and this is true for anybody watching or listening here, all right? First is the cost, that's your interest rate. And then obviously the second one is the expected return if that capital is invested. So the second one being the growth of money. So if a mortgage as an example, right now we're sitting here almost, believe it or not, mid-year 2023, okay? If your mortgage is over a year old from right now, back into the 2022 and before, the interest rate is likely around 3%. So if you think about it quickly, if an investment is paying 5% as a hypothetical, holding off on paying the mortgage is probably the prudent move. Why? Interest rate arbitrage, my friends. Sounds pretty fancy, okay? But hear me out. Say hard work or good fortune has you holding, as an example, $200,000 in cash, and your mortgage, let's say, stands at $100,000. Paying off the debt and investing the remaining $100,000 would earn you $5,000. That's a net capital of $105,000 at the end of the year. Makes sense, right? Now, if you were to invest the full $200,000, basically not paying off the $100,000 mortgage, the net capital at year's end would amount to $107,000. That's $200,000 earning 5%, and you want to basically less the $100,000 debt and the $3,000 interest payment that we're assuming on that. So as long as growth is greater than cost, having debt actually is a sound decision. I want to say that again. As long as growth is greater than cost, having debt is a sound decision. I'm going to talk about this in a few minutes on some notes that I put together here. But this, by the way, is how corporate America runs. And I'm going to walk into that as we go into things like leverage debt buyouts and different things like that, the old LBO world in the 90s. Now, by the way, I should say something very unequivocally here. The same principle holds true with companies as I just mentioned. But hear me out. Here at One Capital, we consider buying a company's stock or debt. When we're looking at that, we first consider the appropriate debt level for the industry. So we look at that, and then what is the company's ultimate cash generation versus interest expenses? So a good measure of this, by the way, for those of you technical and traders out there listening to this, a good measure that we look at is their earnings before interest and taxes, otherwise known as EBIT, divided by their total interest expense ratio. Basically, earnings before interest and taxes are deducted at that point. Now, the company that we might be looking at or investing in, the company has to be generating enough actual cash to cover servicing their debt. Obviously, like us in household, no different, right? We have to make sure that we're earning enough to cover the debt that we may or may not be taking on. Now, ideally, this number would look like 7 or 8 times more than is needed to simply cover interest expenses. That's kind of a metric. Now, this allows room, obviously, for companies to weather a slowdown in sales or in earnings, when the unexpected, if you will, hits. By the way, there's been no shortage of late, right? Pandemic, natural disasters, wars, etc., of unexpected hits. No different than our investments, right? And of course, we also want to consider when the company's debt must be repaid, obviously, and their ability ultimately to borrow even more money if needed. So all these factors go into play when we're looking at investing in a company for our clients. Now, we also look at the company's future projects and earnings expended from the growth and the expansion, basically why a company would be taking on debt in the first place. Now, if the company, right, can generate more cash than it costs to issue debt, basically interest on borrowing, then again, like my mortgage example, they will net more money than had they not taken on the debt, right? Just math. Now, short-lived, I think, is the career of the CEO of a fast-growing company who announces to the board, right, no returns this year, but we paid off the debt. We're aware of that. Now, remember, there's an old business adage that I think is important. If you're not growing, you're shrinking. Now, it's important to understand this as a country as well. Fun fact, by the way, we're not really interested, personally here at One Capital, in a company that doesn't have debt. That might be a little another mic drop moment for a second. We're actually not interested in a company that doesn't have debt. Without it, another company, think about it, or corporate raider can buy the company and essentially issue debt from it to help pay for the purchase. By the way, this is the old leverage buyouts. This was all it was based on, okay? Buy a company, issue a bunch of debt, usually an unsustainable amount, and then take cash out to line the pockets. Not saying this is right or wrong, but that's how corporate America was working for a long time. Now, the same true principles apply for our U.S. government. So shifting from private sector corporate America to our government for a second, again, not a political situation, just walking us over there, right? A high level of debt, this is another controversial statement today, a high level of debt is actually fine so long as it's able to service the debt and then ultimately grow the economy, and also, like companies, like our own personal finances, be prepared for the unexpected. This gets us back to the principle today around the debt ceiling. Everything, as always, needs to be understood through the lens of context. It's very simple for our personal finances, for a CEO running a public company, for us as portfolio managers and investors looking at investing in a company, as well as for our government.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Now, let me give you an example. If the economy grows at 2%, let's just use that, and we also have the Fed's target, not right currently, but the target of 2% inflation, that's a 4% growth nominally. That's how that works, okay? Now, tax revenues, assuming the status quo, would also grow by 4%, giving the government money to pay budget outlays. For a quick reference point, for ending year 2022, a few months ago, the government collected $4.9 trillion in 2022. So that would increase revenues essentially to $5.1 trillion next year. The current debt, as it stands, is right around $31 trillion. And as obviously, as we all know, and this is one thing that's been widely speculated and discussed, is it's been growing for years. I mean, obviously with the bank bailouts of 2008, pandemic recovery spending, quote unquote, the unexpected, this all contributed to the mightily increase that we've been seeing. So what's alarming to us, at least for now, is the debt is about 120% of GDP. This, my friends, is where you get debt and assets and income out of whack. All right. Now, that may seem to many when I state that a big problem, but I think what will come clear here over and over in the coming months is that might be debatable. So hear me out. If an individual finds themselves unable to service debt, there are a few solutions. We know. Maybe they'll sell a car or other assets. I've gone through many of these plannings with clients over the years. These are all temporary at best. Finding a higher paying job is not only difficult, but also takes time. So there's also a time constraint on our debts and our assets, is there not? Now, unlike us, unless you're on the wrong side of the law, the government can print money. They also, right or wrong, with the swipe of a pen, can raise taxes or sell treasury bills, notes, and bonds to do these kind of things. Now, they can never be, as the saying goes, cash poor. These solutions, however, and of course, can come with repercussions. This has been widely speculated, and I want to break this down today. Higher taxes can reduce productivity and growth in an economy, as less money, right, is available to spend on either goods and services or the expansion in the business sector. This is basically every capitalist's dream, right? That's what they want. Less taxes, less regulation, allows for more production, allows for more employees, allows for more compensation, et cetera, et cetera. Now, too much debt can lead to the loss of confidence in the government's ability to service the debt, which ultimately leads to higher interest costs and really, as we've seen, volatility in the financial market. Now, as we have seen, printing money can lead to inflation, okay? I'm not saying some shocking statement there in saying that. And as we have seen recently, obviously with the massive increase in the money supply, something I've been speaking about heavily here on our show, during the pandemic, right? Basically, they were trying to fight, central banks are fighting currently this inflation by what they already did. Essentially, the cure was almost worse than the disease, which I've been sharing for many years now. So all this to say, there's a $1 trillion question out there, believe it or not. Not even the $1 million question, the $1 trillion question. Can the US government ever have too much debt? The answer is yes. The real and hopeful eternal question is exactly how much debt is too much. Nobody knows the answer to that. I want to be very clear about that. By the way, as always, if someone is out there specifically saying like when the world's going to end or, how much exact debt or this, that, and the other, these gnarly statements that you're seeing out there, trust me, if they're that matter of fact, they're probably wrong. They're selling you fear. They're selling you something, okay? Because nobody knows the answer to that. But we're not there yet, okay? The US economy grew by 2.9% in the fourth quarter of last year. Inflation has come down from obviously historic highs, with prices rising at their lowest and slowest pace in nearly 2 years, having climbed, by the way, 5% in the 12 months that ended in March, a month ago. Now, not quite at the rate we need to get the economy humming along, but it's a good sign, okay? And this could lead to eventual lowering of interest rates that plague all who owe, all right? Including the government. Remember, raising the debt ceiling, back to our original point today, allows the government to service debt it already has. I want to be clear about that. By raising the debt ceiling, it's allowing the government to service the debt it already has. Defaulting, as we can very well see, could devastate financial markets, which will likely punish things like our retirement plans, speaking to everyone out there right now, and other investments, and downsize or frankly capsize some businesses and ultimately take jobs out of the economy. For better or worse, it has to be raised. All right, I think I spoke about it a month or two ago. Actually, it was a couple months ago now when this was starting up in January. And the reality is you're going to have political sides to this, and I understand it, but it has to be raised. Congress, at least the vast majority of members, know that. And if you look back at my show in January, and many clients who are listening, I've talked about this as well. When I say it has to be raised, what I mean is this. It has to be raised to, again, service the debt it already has based on what's gone on in the past few years. But what we can look at is making sure that we bring to light, the biggest thing I want to mention here, bringing to light the money supply, not the interest rates only, the money supply. We also need to stop our spending. Like this is the same we do in our budgets for our own personal finances. I'm praying that our governments on both sides can stop it, can not only raise it, that's fine, because we have to service our debt, right, to keep everything going, but we also need to fix our spending. No different than you and I do when we're paying our debt. Like I tell people all the time when we're talking about debt planning, which we do often here at One Capital Management, and this may be a bad way to say it, but debt is a symptom of a disease. It's not the disease itself. We look at debt sometimes like bad. Oh my gosh, we're so disease ridden. No. That is the result of something else. That is the result of overspending. That may also be the result of something unexpected that we have to do. But the idea is to make sure that if we're going to focus on paying it down, and for our government's perspective, focus on raising the limit to service the debt we already have, we need to do it twofold. It's a two-punch game. It's not a one punch and done here, all right? This is a raise the ceiling to pay the servicing of the debt that we already have, done. Number two is stop the spending, right? If we were to look at your debt right now, and anyone listening right now, whether it's a mortgage or a credit card, typically something unsecured, we focus on paying down a debt and we'll do things like snowball, the debt avalanche method, a lot of really great tools we have, which we can help with if you're out there servicing that, but it's a two-pronged approach. We can't just pay it down and then say, okay, great, I paid it down, I'm gonna go right back into it, then why even do it in the first place? And that's, my friends, where the rubber meets the road. So just to put a bow on today around the debt ceiling conversation and walking you through some debts and how to look at debt, both personally as well as I brought up kind of what's going to be happening here in the next few months within our government, a more useful debate to us after the debt ceiling likely is raised is, again, how to make the governments more fiscally responsible. Debt is fine, often good, so long as there's an ability to service it. And it's adding to the economy's expansion if you look at the numbers. You figure that out or even have the conversation, and there's actually, friends, reason to celebrate with or without the ceremonial burning of mortgages. I want to thank you for listening to the Make Your Money Matter show. As always, before acting on anything discussed today, speak with a financial advisor near you about your specific situation. Or if you like our help, again, you can reach us at onecapital.com. You can set some time with myself or any one of our fiduciary advisors, or give us a call, 805-410-5454. And always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.